Your portfolio can quietly change its risk level even when you do nothing. Rebalancing is how you bring it back on purpose without turning investing into a daily hobby. At its simplest, rebalancing means returning your investments to the mix you originally chose. If your plan is 60% stocks and 40% bonds, rebalancing is the process of moving the portfolio back toward that target after markets have pushed it away. Portfolio drift happens because different investments grow at different speeds. Stocks may rise faster than bonds for a while. International funds may lag behind domestic funds. Cash may build up from dividends or contributions. Over time, the portfolio you own can become different from the portfolio you intended to own. Think of asset allocation like a steering wheel. You choose a direction based on your goals, time horizon, and comfort with risk. Rebalancing does not guarantee a smoother road. It simply keeps the steering wheel from slowly turning without your permission. A common mistake is thinking rebalancing is a magic way to boost returns. Sometimes it helps because it trims investments after they rise and adds to investments after they fall. Other times, it can reduce returns if the winners keep winning. Its main job is risk control, not prediction. Imagine a $10,000 portfolio with $6,000 in stock funds and $4,000 in bond funds. That is a 60 and 40 mix. If stocks rise and the portfolio becomes $7,000 stocks and $4,000 bonds, stocks are now more than 60% of the total. Nothing dramatic happened on the account page. There was no warning light, but the portfolio became more stock-heavy. If the investor still wants a 60 and 40 plan, the risk level has moved away from the plan. Rebalancing is the act of correcting that gap. The problem is that rebalancing too often can create its own damage. Frequent trades may create taxes in taxable accounts, spread costs, fund restrictions, or simply a habit of constantly checking prices. A good rebalancing rule should reduce drift without making the portfolio feel like a video game. The way to avoid overtrading is to decide the rule before emotions show up. If you only rebalance when you feel nervous, excited, or annoyed, the process becomes market timing in disguise. A rule gives you a calm reason to act, and also a calm reason to do nothing. The first common method is calendar rebalancing. You choose a schedule, such as once a year or twice a year, and you review the portfolio on that date. If the mix has moved away from the target, you bring it back. The strength is simplicity. The weakness of a calendar rule is that markets do not move on your schedule. Your portfolio might drift a lot shortly after your review date, or barely drift at all by the next one. Still, for many long-term investors, a boring calendar can be better than constant monitoring. If this kind of calm, practical money explanation is useful, consider subscribing. The goal here is not to make investing feel complicated. It is to make the basic rules clear enough that you can build a plan and stop second-guessing every market move. The second common method is threshold rebalancing. Instead of acting on a fixed date, you act when an allocation moves far enough from its target. For example, if stocks are supposed to be 60%, you might only rebalance if they move beyond a chosen band around that target. A threshold band is like saying, close enough is close enough. If your target is 60% stocks, a band might allow stocks to move a few percentage points above or below that before any trade happens. The exact band is a planning choice, not a universal law. Bands help because tiny drifts are usually not worth a lot of action. A portfolio that moves from 60% stocks to 60.4% stocks has changed on paper, but not in a meaningful way for most people. A threshold keeps small movements from becoming unnecessary trades. When people talk about thresholds, they may mean different things. An absolute threshold looks at percentage points. A move from 60% to 65% is a 5 percentage point drift. A relative threshold looks at the size of the move compared with the target. The key is to define it clearly. There is no perfect threshold for every investor. A very narrow band can cause frequent trading. A very wide band can let the portfolio wander too far from the intended risk level. The right idea is not precision for its own sake. It is a workable balance between discipline and friction. Many investors use a hybrid approach. They check on a calendar, but only trade if the portfolio has drifted beyond a threshold. This gives the routine of a scheduled review while avoiding trades just because a date arrived. It turns rebalancing into a decision rule, not a ritual. Suppose an investor reviews every January. Their target is 70% stocks and 30% bonds. They decide ahead of time that they will not trade unless either asset class is meaningfully away from target. In a quiet year, the review might end with no trade at all. That no-trade result can feel strange. People often think a review should lead to action. But in a good system, doing nothing can be the correct outcome. The review is not there to create activity. It is there to check whether activity is actually needed. One of the cleanest ways to rebalance is with new contributions. If bonds are below target, future deposits can go more toward bond funds. If international stocks are below target, new money can go there. This can reduce drift without selling anything at all. The same idea can work in reverse for withdrawals. If someone is taking money out of a portfolio, they may choose to withdraw more from the asset class that is above target. That can bring the mix closer to plan while also meeting the cash need. Dividends and interest can also help. Instead of automatically reinvesting every payment back into the same fund, some investors direct cash toward the part of the portfolio that is underweight. It is a gentle way to correct drift over time, especially when the drift is small. Taxes can change the best way to rebalance. In tax-advantaged retirement accounts, selling one fund and buying another may not create the same immediate tax issue as it could in a taxable brokerage account. In taxable accounts, selling winners can create realized gains, so the cost of action matters. A portfolio can be spread across several accounts. A 401k, an IRA, a taxable brokerage account, and a savings account might all play different roles. Rebalancing only one account in isolation can miss the bigger picture. The target allocation usually makes more sense when viewed across the full household portfolio. There is a danger here, too. Trying to optimize every account, tax detail, and tiny allocation gap can become its own form of overtrading. Good rebalancing should make the plan easier to follow. If the system is so complex that you avoid it, the system is not helping. Rebalancing may look like market timing because it often sells what recently went up and buys what recently went down. But the purpose is different. Market timing asks, what will happen next? Rebalancing asks, what did I say my risk level should be? During volatile markets, thresholds can be triggered more often. That does not automatically mean you should keep trading every day. A written rule can include how often you check, how far you trade back, and whether you use cash flows first. The point is to prevent panic from writing the rule in real time. You do not always have to rebalance all the way back to the exact target. Some strategies bring an asset back inside the band instead of all the way to the center. This can reduce trading, especially when prices are moving quickly. The trade-off is that some drift remains. Thresholds become tricky with very small slices of a portfolio. If an asset has a 5% target, a small dollar move can look large in relative terms. That is one reason beginners often benefit from keeping the portfolio simple. Fewer moving parts usually means fewer rebalancing decisions. Rebalancing is especially important when one holding grows into a large part of the portfolio. This might happen with an employer's stock, a hot sector fund, or a single investment that performed very well. The gain can feel great, but concentration means one position has more power over the whole plan. The hardest part is often emotional. Rebalancing can ask you to trim something that has been making you feel smart and add to something that has been disappointing. That is why the rule matters. It lets you follow the plan when your instincts are chasing recent results. A simple rebalancing policy can fit on one page. It can say the target allocation, the review schedule, the threshold for action, which accounts to use first, and how to handle new contributions. The policy does not need to be fancy. It needs to be clear before markets get loud. A calm process might look like this. First, check the full portfolio on the planned date. Second, compare each asset class to its target. Third, use contributions, dividends, or withdrawals if possible. Fourth, only place trades if the drift is large enough to justify the cost. Avoid checking so often that every market move feels like a command. Avoid changing the target allocation just because recent performance made another mix look better. Avoid treating rebalancing as a way to predict the next winner. The best version is usually boring, repeatable, and connected to your real goals. Rebalancing without overtrading means accepting that perfect balance is not the goal. The goal is to keep your risk close to your plan with the fewest reasonable moves. Calendar rules create routine. Threshold rules create restraint. Together, they can keep the portfolio from drifting without making it your hobby. If you have questions about rebalancing, threshold bands, taxable accounts, or building a simple portfolio rule, leave them in the comments. And if there is another personal finance topic you want explained in this style, suggest it below for a future video.